US banks are in some pretty serious doo-doo right now, and with interest rates being high and likely staying there for a while, we're going to keep seeing pain for the banks. This means our economy is in serious trouble. You have to make sure you position yourself correctly. So let's break everything down. Now, earlier this month, Moody's downgraded 10 regional banks with likely more to come. So what does it mean when a bank is downgraded? It means they believe the bank is now a riskier place to lend money or invest in compared to before. This is based on many different factors. As a result, the bank might face higher borrowing costs, wary investors, and cautious customers. This could cause a bank run and ultimately a bank failure, as we saw with the Silicon Valley Bank collapse a few months ago, and I tried to tell people that was just the beginning. So let's jump into this. This is a report from CBSNews.com, August 9th, 2023, and they say banks get a downgrade from Moody's. Here are the 10 lenders impacted. And here are the 10 lenders they are talking about that were impacted by this downgrade. There's also 6 banks with ratings under review, and the worst part, there's 11 banks with negative outlooks. Why I don't like this is because there's some really big banks on this list. We see some of those banks include PNC, Capital One, and Citizens Financial Group. These are some very large banks. Also, we can see from this article from CNN.com on August 21st, 2023, S&P downgrades 5 U.S. banks following Moody's lead. You can see the 5 U.S. banks right here, with the biggest one being KeyCorp, one of the top 20 banks in the United States. Now, if all that wasn't bad enough, there are also much less jobs than we thought, which means our economy is even weaker than we thought. This is an article from Bloomberg.com on August 22nd of 2023, and they say 500,000 U.S. jobs at risk of vanishing in payroll revision. Government to issue preliminary benchmark employment revision. And then they say pace of job growth moderating, yet still viewed as healthy. Yeah, whatever you say. Now, if all of that wasn't bad enough, it also looks like the commercial real estate sector is in some serious trouble as well. Office mortgages are starting to default massively, making the banks want to dump those loans. Borrowers are defaulting on their payments, and the banks are going to take more hits. So as this commercial real estate sector starts to get worse and worse, and it's looking like it's going to, the banks are going to get even worse than what they are right now. Now, we have an article from Investopedia.com here in June of 2023, and they say warning signals in U.S. commercial office markets haven't stopped flashing. Property investment has plummeted, leasing activity has dropped, delinquencies have surged, and maturing loans face starkly higher refinancing rates. By any measure, the market for office property has tanked. Office-based Real Estate Investment Trust, or REITs, measured by the FTSE Nareit Equity REIT Index, dropped 37.6% in 2022 and another 18.1% in the first 4 months of this year. So if we take a look at this graph here, we can see in the first quarter, leasing activity dropped for the third straight quarter, sinking 42% below pre-pandemic levels. As you can see, the U.S. office leasing activity graph here, we are at a very low point right now, and it is just only dropping. And a third of all market leases will also expire between now and 2026. There's also some troubled loans. So, in addition, Mellett estimates $340 billion of office loans on bank balance sheets will mature in the next 2 years. About $30 billion of those may default. So as we can see, there's some serious trouble going on, not just with the banks, but with the commercial real estate sector, which has a big effect on the banks. So as this commercial real estate sector starts to get worse, it's going to put even more strains on the banks. Now, if that wasn't bad enough, we see this article from APnews.com, and Fed's Powell says, more rate hikes are likely this year to fight still high inflation. That means this is just going to compound everything even more. As the rates go up, it's going to make everything worse. So I don't really understand how anyone saw this as a surprise. I mean, we just go back to our U.S. debt chart. This is our historical debt from 1790 to 2022. Now, what you see here is a graph that is very stable for a long time, and all of a sudden it just goes up at an exponential rate. So what happened here? Well, what happened was in 1913, the Federal Reserve was created, okay? And they had a goal of getting rid of a gold standard so they could just print money as they wanted. Now, this was a slow process. Of course, they'll take inch by inch until they get a mile, then they'll run with it. Now, what happened here is in 1913, there was a 40% reserve ratio. This meant that for every $100 that was out there had to be $40 in gold. That's a 40% reserve ratio. Or if there was $50 out there had to be $20 in gold. 40% reserve ratio. That lasted until about 1944, where the Bretton Woods system was established. Now, under this system, gold was set at a price of $35 an ounce. Never good to set a price of something. And that was backed by the dollar, and this was like a worldwide thing. That lasted until 1971. Now, for many different reasons, I'm not going to explain right now. Bretton Woods system was ended in 1971, and the whole world went on a fiat currency at that time. So when there's no gold to equalize things, well, then you can print at an exponential rate. You can print however much money you want because there's no money to back it. When gold's there to be the equalizer, you can't just print because you need to have gold backing it. In 1971, that went out the window. The Fed got what they wanted, and they started printing away. The problem is they're now printing at an exponential rate. In the last 4 years, we've accumulated over $8 trillion in debt. So our nationwide debt is a little over 31 trillion. We've done 8 trillion of that in the last 4 years, around 8 trillion. That's over a quarter of that in the last 4 years alone. What goes up must come down. On top of this, we have other numbers that are alarming. So commercial bank interest rate on credit card plans are at an all-time high. So basically credit card interest rates are the highest they've been since this graph goes back to about 1996. We also have delinquency rates on credit card loans expanding very quickly. Also, the 30-year fixed rate mortgage average in the United States is rising very quickly. We can also take a look at household net worth. We're looking at the percent change from a year ago, and we can see a major drop off here from 2021. The last time this happened, you want to know what happened? A big recession. And this drop off is way bigger than that one. Okay, you see a big drop off, big recession. Little drop off, somewhat smaller recession. See a little drop off here, and we had a little recession there. So that's another alarming issue. You can also take a look at the retirement asset levels, right? So you see a major drop right here, which is not good. When you saw a major drop in 2008, the same thing happened, a recession. And if we go change this to percent change from a year ago, we see something again alarming. Notice a little change here, little recession. Pretty big change down here, and we had a somewhat little recession. Huge change here, big recession, even bigger change right here, likely an even bigger recession. So I don't really understand how anyone saw this as a surprise or how anyone can argue that we're probably not going to go into recession. I mean, all the signs are pointing to that. Unless the Fed pulls something out their butt, which they could, they're just going to kick the can further down the road and a recession will just come later on. But when you do this, when you send the debt up this fast, this quickly, and you print that much money with nothing backing it, it's going to end up going down. Okay, what goes up must come down. So you need to protect yourself. Now, as an investor, I want to put my money in the right place at the right time. I love commercial real estate, but I don't love commercial real estate right now. I invest in commercial real estate, but I'm not investing in commercial real estate right now. Right now, I like to invest in precious metals because history shows us that in times that this happens, precious metals do extremely well, and there could also be a very large wealth transfer that goes into precious metals coming very soon. Now, I've been in the industry of precious metals for many years, it's been about 15 years now. I know many of the CEOs out there, I know many of the top companies, and I actually have many investments myself in both physical gold and silver and a gold IRA. If you want to get hooked up with a company that's very trustworthy that I use, go to investingingold.com/quiz and you'll get some questions which will take you about 30 seconds. Go through them, and depending on your answers, I'll connect you with a company that is right for you, that is highly trustworthy. Just make sure you protect yourself right now. Look deeper into what's going on right now. Just continue to educate yourself. Look into all the bank problems. Look into what's going on in commercial real estate. Educate yourself and start to move your funds around. Put them in places that make sense. Hope this video helped you. Make sure you like, comment, subscribe, and I'll see you in the next video.